Hello everyone, warm welcome to Testbook Super Coaching. My name is Madhav Sir. There was some technical issue because of which I was not able to go live. But yes, now I am live. I can check this. Okay, okay, okay. Okay guys, so today the topic is very interesting and the topic for the day is risk. See, I have two sessions today. In the first session, that is on YouTube, I will be discussing with you the types of risk. After discussing the types of risk, I will be discussing the techniques which we must follow in order to manage the risk. So, management of the risk will be discussed at 9 p.m. and it will be discussed on at 9 p.m. and it will be discussed on the Testbook application, but types of risk will be discussed in this particular session itself. So before I start the discussion, may I have a reply in the comment section for a very simple question? What do you understand by a word risk, or how you define a word risk? See, whenever we use this word risk basically means possibility of loss in near future. In very simple terms, it is basically possibility of loss in near future. But when we talk about risk in the financial world, then we use one more statement and we say that risk basically means probability of loss in near future or probability of earning less in comparison to the estimation. That is also termed as risk. What I'm trying to say, let's suppose you have estimated that after 1 year of your business, you will be earning 10 lakh or let's say 10 crore. You will be earning 10 crore. This is you have estimated. But over the period of time, let's say after 6 months, you realize that the things are not going pretty well and you may end up earning 8 crores. So earlier estimate is 10 crores, but the actual value is now 8 crore. So this is again termed as risk. If the actual value is less than the estimated value of revenue or profit, then that will also be termed as risk. So probability of loss in near future or probability of earning less in comparison to the estimation is also termed as risk. Now, the question is, so the term risk is only and only associated with banks or only with financial institutes? That's not true, obviously. That's not true, obviously, because risk is associated with every business. For example, whenever we say risk basically means probability of loss, and where we can expect loss, where we are trying to earn profit. And where we are trying to earn profit, that means we are into a financial activity, we are into an economic activity, we are running a business. Are you getting my point? Are you getting my point? What I'm trying to say? I'm trying to say that risk is basically what? So risk is basically probability of loss in near future. Risk is basically probability of loss in near future. And where we can witness loss, so where we are trying to earn profit, because profit and loss, they are two sides of the same coin. Either one will happen for sure. And profit making authority, or when you are involved in profit making activity, that is known as economic activity, business activity, or in short it can be termed as business. So if you are into a business, if you are trying to earn profit, then obviously it will be related to risk. And one of the most important facts, the fact is, whenever we talk about risk, I always say, as per the financial term, so risk is directly proportional to return. Risk is directly proportional to return, which means whenever risk increases, probability of return will increase. Whenever risk decreases, then the return value will also decrease. Best example is equity and government security. So whenever you are purchasing equity shares, obviously your risk is high, and simultaneously you can earn good returns, you can earn high returns. But on the other side, if you are investing your funds in government securities, then in that particular case risk is low, because these are the government securities. In this case, your funds are going to be paid back to you for sure, because these are backed by government. But if they are secure, if they are less risky, they are providing you with low returns as well. So this is how we define risk and return relationship in case of finance. So remember that what is risk? In the financial term, risk is defined as the chance that an outcome or investment actual gains will differ from the expected outcome or return, which I already discussed. And risk takes on many forms and include possibility of losing some or all original investments in the near future. Now, see, whenever you have to analyze risk in a particular company or risk in a particular sector, what should be done? My answer to this particular question would be, one second. My answer to this particular question would be, whenever we talk about risk, we must try to understand that risk depends upon your operations. Please pay attention on the screen. You are going to enjoy this for sure. Let's take an example that I'm talking about the risk, or I'm talking about the industry, or I'm talking about an organization, that is bank. I'm talking about the organization, and my organization of discussion is a bank. Now, if you want to understand that what kind of risk bank is going to face in the near future, how can you identify them? So you can identify them very easily. How come? First, you need to identify the operations performed by the bank. So bank is involved in what all operations? So bank accept deposits. Please pay attention. Bank accept deposits. Second is bank provide loan. Bank accept deposits, bank provide loan. These are the two functions. Along with that, bank invest the funds. Bank is involved in investment, because bank invests its surplus in the government securities and even in the share market. Even bank is involved in the foreign exchange. These are the operations which I can identify right now the moment I hear a term bank. Now let's try to identify the risk associated to the same. For example, deposit. So bank accept deposits from the public, and the same deposit is provided on loan by the bank to the public, and bank is earning the profit. Now let's suppose if bank do not accept deposits, or bank is not receiving deposit, if public is not depositing their funds with the bank, then what will happen? So bank will witness a loss, because bank will not have the funds which bank can provide on loan, and bank will not be in a situation to earn profit. So that type of situation where bank do not have deposits to provide loan, that can be termed as a situation where bank is lack of funds. So if bank is lack of funds, bank is lack of cash, that can be termed as liquidity risk. that can be termed as liquidity risk. The same risk can arise in the another way also. How come? Bank has accepted a deposit from Madhav for 1 year and bank has provided loan for 10 years to Atul. Are you getting my point? So bank has accepted deposit for 1 year and given loan on 10 years. If I have given deposit for 1 year, I will be reaching back the bank after 1 year to get my deposits back. But bank has given the same amount on loan for 10 years. So when there is a difference between the maturity of deposit and loan, it may result in what? It may result in cash crunch that can be termed as liquidity risk. So what is liquidity risk? When the company do not possess cash in order to pay its liabilities or in order to pay its day-to-day payments, that is termed as liquidity risk, which can be faced by bank as well as the other companies also. Secondly, so bank is providing loan and bank is accepting deposits. Bank is working in a competitive environment. Now let's suppose if bank competitor is providing loan at a low rate of interest, then obviously bank may lose its customers. Bank may lose its customers. So that type of risk is known as market competition risk. But banking sector is a regulated sector. It is regulated by RBI, and generally RBI has come up in such an arrangement that the competition in the banks is there, but that is more on the service side rather than on the price side. Price bracket is almost same for all the banks. Banks are distinguished on the basis of the services they are providing in India today. But if you have given loan as a bank and the loan do not pay back, or I would say loan do not come back, or loan has not been received, then the loan has been declared as NPA, default. That type of risk is known as credit risk. That type of risk is known as credit risk. Are you getting my point? Now, in case of deposit and loan, there is one more type of risk which I would like to discuss over here. Is that type of risk is involved in both the situations. For example, you have accepted a deposit for 5 years and you have provided the loan for 10 years. After 5 years, you have to pay back the deposit. And in order to pay back the deposit, you may borrow from someone else so that the 10-year loan is still standing and it is still going on. Let's suppose Madhav has given you funds for 5 years. As a bank, you were paying him 5% and you have given the amount of Madhav on loan for 10 years and against which you are earning a return of 12% and the gap of 7% is your profit. After 5 years, you need to pay back to Madhav. So what you did, you borrowed from someone else. And the moment you borrowed from someone else, this time you are able to borrow at, let's say, 6%. So earlier your profit was what? 7%. Now your profit will drop down to 6% because of difference in the maturity. So due to difference in the maturity of deposit and loan, your returns, or I would say your ROI or your NIM, that is net interest margin, may decrease, and that type of risk which is related to the interest rate is known as interest rate risk. When you expect high return, but due to change in market interest rates or due to change in market scenario, if the interest rate changes and your profits fall down, that is known as interest rate risk. When you involve in investment, you involve in forex, you come across with different type of risk which are related to investment. First one, I call it as equity risk. If you are investing in equities and equities prices goes down and up, then we have foreign exchange risk. If you are investing in foreign currency, their price goes up and down. Then we have commodity risk. If you are investing in commodities like gold, silver, then also you will witness the risk. And then one we have, that is debt risk. Debt risk is pretty low because in case of loan, return, I would say the return is prefixed, it is predefined. And if the return is prefixed, predefined, risk is pretty low. But if you have given loan and the party to which you have given loan, the party has run away, that will again answer under the debt risk. So we have 1, 2, 3, 4, 5, 6, 7. Along with this, we have one more risk which is known as reputation risk. Which means if the bank's reputation is not good, everyone will be taking back their deposits from the bank, and obviously bank will not have the adequate deposits to run its operations, so that is termed as reputation risk. Then we have operational risk. Operational risk means every bank has to fulfill the compliances given by RBI, law related compliances, as well as I would say tech related compliances. So in day-to-day operation, if bank is not fulfilling the laws or rules and regulations of RBI, bank is not able to provide the adequate technical support or any other day-to-day miscellaneous working mishappening can be done. For example, you approach to the bank to deposit the funds. Accidentally, bank manager, while entering the account number, he has entered a wrong account number and he has credited amount in some other account rather than yours. So that is a risk. That is a risk not on the customer. Customer will challenge the bank. देखो यार मेरे पास receipt है, इस पे ये account number लिखा है, मेरे account में पैसा क्यों नहीं आया? Bank will be at risk. That is I would say operational risk, which is done by the in the day-to-day operation, which can also be termed as human error. That will also fall under the category of risk. There is one more type of risk which is known as policy risk. If government changes its policy, and due to change in government policy, your returns, your investments, your profits changes, that can again be termed as a category under risk. Are you getting my point? So next time if someone says or asks you, could you identify what type of risk an insurance company witness? So first of all, sit quietly and think what operations are performed by insurance company. Then related to the functions of insurance company, identify the risk which can be involved in the insurance sector out of the list which I have just discussed with you. Is it clear now? If it is clear, just give me yes sir, then we'll move ahead. Now let's discuss one by one. So the first one, we generally classify the risk into two categories. One we call it as symmetrical risk, one is systematical risk, and the other one is unsystematic risk. What is systematic risk? So systematic risk is a kind of risk which impacts the entire economy. Example is COVID-19. These kind of risk which impact the entire economy, all the sectors of the economy, that type of risk is known as systematic risk. These type of risks, they are unpredictable as well as they are unmitigatable. That means you cannot even, if you cannot predict these risks, obviously you cannot mitigate these risks, you cannot control these risks. So these type of risks are known as what? So they are termed as systematic risk. So systematic risk, they cannot be mitigated, they cannot be diversified. If this kind of risk prevails, you have to face that risk and it will impact the entire society. Secondly, we have unsystematic risk. What is unsystematic risk? And unsystematic risk are the type of risk which impact not the entire economy, they impact a set of economy or one section out of the entire set of economy, and maybe in near future one unsystematic risk can lead to another and this lead to another, and this leading of n number of unsystematic risk may turn into systematic risk in near future, but that is different. So we have discussed what is interest rate risk, we have discussed what is exchange rate risk, then we have discussed the risk which are related to equity market, which are related to commodity market, stock market. Then we have discussed political risk. I have named it as policy risk. You can even term it as political risk because policies are framed by government, and so let's divide them in two categories. Let's keep them separate only. Political risk means when there is political instability and Policy risk means when there is a wrong policy or inappropriate policy has been introduced. In case of unsystematic, we have different types of risk in the category of unsystematic risk, in which we have discussed about different risks. One is the risk which is involved in a particular sector itself. But you know what? Unsystematic risk has certain advantages as well as certain disadvantages. What are the advantages? It relates only to a particular company or industry, unlike systematic risk. It can easily be avoided, reduced, and it can be easily mitigated. Factors that lead to unsystematic risk, they are generally internal and they can be minimized. So what I'm trying to say, if someone asks you, what are the advantages of unsystematic risk? That doesn't mean he's looking forward an answer from you that why unsystematic risk is beneficial. No. He's trying to ask what are the benefits of unsystematic risk over systematic risk. Is it clear? So beside that, all the risks have been discussed with you in much detail. But if you want the content, you want each and every point to be mentioned over your content, then you can join our upcoming courses which are going to be live pretty soon. Is it clear, guys? So I have discussed all these risks. If you want the content which I have just shared with you, if you want the content also, then you have two options. First option is you can join my Telegram channel, but you won't be able to get the content for all the finance topics. If you want the content for all the finance topics and that too in much detail, then you must join our Lakshya batch, RBI Grade B 2025. Use the code MADHAV in order to enjoy maximum discount. So that will be all from my side, guys. Sorry for starting the class bit late. There was some technical issue, but we'll start 9 p.m. session on time where we will be discussing risk management. So now we have discussed what is risk. Then I will be discussing with you how we can manage the risk in general again. And in the upcoming sessions, I will be discussing specific risk related to the banking sector and specific risk management techniques related to banking sector. So don't worry, do join with me in the upcoming sessions as well. Thank you so much. Catch you at 9 p.m. on Testbook application. Thank you. Bye bye. Take care. Good luck.